Hello, welcome back to Financial Management. This week, we're going to talk about financial options and real options. Last lesson, we looked at forecasting cash flows. We've gone through financial management and market efficiency, choosing the correct discount rate for our cash flows. We built pro formas. Now we're going to look at financial options. Now, these are going to be derivatives. A derivative sounds very complicated. I promise you it's not. It's a financial instrument that provides you the right to buy or sell an asset at a pre-specified price. Huh? The main intuition behind financial options is that we want to buy low and sell high. Once we establish this intuition and once we understand how financial options work, we're going to apply this concept to valuing real options. So this lecture will come in two parts. Our first will focus on financial options, which will cover chapter 8, and the second, which will be uploaded separately, will focus on real options, which will cover chapter 22. So options, a European call option. You've probably heard the term call option, very familiar with it if you've had this material before. If it's your first time to kind of be introduced to these concepts, hopefully we'll be able to build them out. So the European call option gives you the right, but not the obligation, to buy an asset at a pre-specified price. That pre-specified price is going to be called the strike price. With a European call option, I have to wait until the option matures in order to exercise it. So before we get into an American call option versus a European call option, let's make sure we understand why we want a call option in the first place. I want to use a call option because I always want to be able to buy low. If I expect the stock price to go up, I want to lock in a low price today. I don't want to be forced to buy that stock. I want the right to buy that stock. So I'm going to use a call option. With call options, they come in a European, American, and many other types. The main intuition behind the American call option is that I don't have to wait until the option expires or matures to use it. I can use it anytime before. So if I can use one option only when it matures, and I can use one option whenever it's good for me, you can hopefully see the intuition that the American option will have a higher value. Now in this class, we're going to mostly focus on using European call options because they're much easier for us to price. A European put option. A put option will give you the right but not the obligation to sell an asset at a pre-specified price at the expiration date. Same intuition with an American and a European put option. With an American put option, I can use it whenever I want. With a European put option, I have to wait until maturation. So why would I use a put option? Well, the intuition behind the put option is we always want to sell high, meaning if I expect the price of this asset to fall in value, I want to be able to lock in a high price today that I expect will be higher than the price when this thing falls. Let's go through some notation. We have a strike price K, an expiration time, time capital T, current time, lowercase t, and then the stock price at expiration, S subscript capital T. There's the price for the call option, which will be C, and the price for the put option, which will be P. Those prices are going to be a function of the current stock price, the strike price that we lock in, and how long we have to use the stock, amongst many other things. But those are sort of the fundamental things that we'll think about. So let's look at our payoffs. Our payoff for the call option is going to be the max between the stock when this option matures and the strike price, or 0. Our payoff for the put option is going to be the max of the strike price minus the stock when it matures, or 0. Automatically, hopefully you can see that these payoffs are both bounded by 0. So the value of the call option and the value of the put option, us agreeing to buy these things, we're able to lock in profit payoffs that are positive without being forced to hold a security. So when you see that call option, ST minus K, let's put real numbers into it. Suppose that I expect that the stock, it's currently trading at 50 and I think it's going to go all the way up to 100. What would I do? I would buy a call option with a strike price of 50 because I expect that it's going to go up. And if the stock goes up, I'm going to use my call option and have a positive payoff. If the stock falls below 50, I won't touch it. So it's going to be bound between the max of the stock minus the strike or zero. Let's look at that put option. Suppose right now the stock is trading at 75 bucks per share. I think the stock is overvalued and it's going to fall down to 50. What am I going to do? I'm going to lock in a put option with a strike price of 75. Why? Because as the stock falls in value, hopefully I'll be able to make money off of my expectations. Now, if you're the person who's selling the option, you get the negative of these payoffs. And we'll look at the payoffs in a graph later in the lecture. I want to be clear that payoffs are different from profits. When we think about the profit of an option strategy, we have to take into account the fact that we actually paid for it. So you'll notice that our profits are the max of the payoff of the option minus the price of that option, the price of the call and the price of the put. Okay, so C and P, these are option prices and they have an expiration. Again, the seller is always going to get the negative of the buyer's profit. So the profit's going to account for the price that you initially paid or received for the security, while the payoff does not. Let's look at profits versus payoffs. Suppose you own a European call option that has a price, an exercise price for a strike price of 55. So let's think about this. We bought a European call. It's got a strike at 55. Provide the payoffs for the call option, given all these different values that the stock price can fall at. Well, let's take a look. So in this example, we've got the option maturing, we've got the stock falling at a value of 0, 35, 54, 55, 56, 75, and 110. So first, let's look at the buyer. If I'm the person who's bought this option, anything below 55, I'm not going to use it. Why? Why would I pay you $55 for a stock that's trading at 40? I wouldn't. Rather than use that option, I would go to the market to buy the stock. Notice how everything above 55 has a positive payoff. Well, let's think about that. If I look in the market and the stock is trading at 75 bucks per share, but I can buy it from you for 55, of course I'm going to do it. And hopefully you notice that the seller has the exact opposite payoff. When you're the person who has provided this option, for every dollar that the buyer gets, that's a dollar that you lose. So it's the exact opposite in terms of payoff. Suppose you own a European put option that has an exercise price of $55 per share. Again, let's look across all these different possible payoffs that the stock price can land at and see what your payoff would be as a buyer versus a seller. What do you notice? Well, when I'm buying the put option, it has a strike price of 55. Stocks are bound to 0. So suppose that you buy the European put option and the stock tanks. It goes all the way down to 0. The maximum that I can get from selling something that has a price of 0 to you that has a price of 55 bucks per share is 55 bucks. Notice that it's capped at the payoff where the stock is at 0, our payoff is 55. And as the stock price goes all the way here to 55, our payoff goes to 0. And let's make intuitive sense of that. I bought the right to sell you this stock for 55 bucks per share, meaning that as long as we are anywhere here below 55 bucks per share, I'm going to sell it to you. Once the stock is trading at 56, 57, 58, I would lose money selling it to you, so I would never do it. I would just go sell it in the open market rather than use our option. And hopefully, again, we can observe that the payoff for the seller is the exact opposite of the payoff for the buyer. It's the negative of the payoff for the buyer. So let's look at some profit diagrams. Now, In our previous example, we really didn't factor in the fact that you actually have to pay for that option. So suppose that our call option example costs you $2. What you'll notice is that now your profit, it's going to be well below zero. And when we get to 55, that was our strike price, you can see that you're still here at -2. Your profit is still at -2 because you paid $2 for the call option. So it's not until we get to $57, meaning that I can sell it to you for 55, but when I take into account the fact that I still had to pay 2, it's not going to be profitable relative to what I paid until we factor in that cost. So that's how it crosses at 57. Two more diagrams that are going to be very important when you talk about pricing a stock or pricing an option. These are just very helpful diagrams. The first I want to show you is the payoff for a stock. What does that mean? Now, notice how this is perfectly along the, the 45-degree line. What does that mean? It means that if the stock right now has a value of 70, if I sell it, I get $70. Okay, so it's 1-for-1. The payoff of the stock is 1-for-1. Let's look at the payoff of a risk-free bond. Why is it like this? Well, suppose that the risk-free bond pays some face value K, and it's assumed to mature at time T. So this is all relative to maturity. If I have a risk-free bond, it doesn't matter where this falls at. Suppose that we think about this less in terms of stocks and bonds and more in terms of a credit card. If I told you that your credit card had a value of $500 on it, you're not going to pay 501, you're not going to pay 502, you're only going to pay off the face value of the debt. And that's sort of the same intuition. That's why it's this flat line. Okay, we're going to use those payoff diagrams later when we figure out the correct way to price a stock and the correct way to price a call option. So let's go through a bit of terminology. We say that the option is in the money for the call option when the value of the stock is above the strike price. Remember, you want to buy low. So it's in the money if it's profitable for me to use it. For the put option, it's the exact opposite. Remember, you want to sell high. So if the strike price is above the value of the stock for the put option, then we say it's in the money. At the money is when they equal, and out of the money is when it's not profitable. So for the call option, suppose that the strike for the call option is 55, but the option itself is trading for, or the stock itself is trading for 50. Well, that's out of the money. Why? I wouldn't buy it from you for 55 when I can go buy it in the market for 50. And for the put option, it's the exact opposite. Suppose that the strike is less than the value of the stock. So suppose we have a strike of 75 and the stock is trading for 80. I would never use that put option. I would never sell you something for 75 that I can go sell in the market for 80. So this is how we think of this terminology. If you have time, go ahead and take a look at some actual options and see how they are traded. It's very interesting. So the way that we'll think about these option values, generally, the deeper out of the money an option is, the cheaper it is, and hopefully that makes intuitive sense. If it's more likely that this option is going to be something that you use because it's profitable, then you're going to pay more for it. The other thing we want to think about is the volatility of the stock. So when stock prices are more volatile, the call and put options will become more valuable. Well, why is that? Well, obviously, if something's more volatile, it's going to move up and down a lot. And if it's moving up and down a lot, there's a better chance that it's going to move up or move down relative to the strike price. So there's a higher chance that we'll end up using it. Call and put options are typically more valuable when they have longer times to expiration. And hopefully that makes intuitive sense. If I've got 1 week for this option to be in the money, versus 1 year for this option to be in the money. If it's got a whole year, well, that's more time for it to actually finish in the money. So I'm going to pay a higher price for it. So the deeper out of the money, the deeper in the money, the more volatile, and the more time, those are all going to affect the price of the option. What we're now going to do is look at some different option strategies. So we can create ways of hedging risk or mitigating risk, or ways of speculating. For example, what kind of payoff profile would we have if we bought one call and one put with the same strike price? And we're going to assume everything has the same maturity. So let's look at some different option strategies. The one we just mentioned is called a straddle. So for all of these, we're going to assume that all of the options that we buy or sell have the same maturity. With the straddle, we're going to buy a call and buy a put with the same strike price. We can also have a bull spread. With a bull spread, you buy one call, you short one call. The strike price of the first call that you bought is less than the strike price of the second call that you sold. And there's also a bear spread, which is sort of the opposite. We also have a strangle, where you buy a call and buy a put, but the call and put don't have the exact same price. Lastly, we have a collar, where you buy a stock and you buy a put and you short a call. And then we also have a butterfly, where you buy a call, short two calls, and buy a call. So some of the actual mechanics of us building these can be a little bit complicated, but I want to make sure we understand how to apply them and what the intuition is. So let's look at our first option strategy, which is the straddle. So in this example, we're going to long a call and long a put with the same strike price. And to explain, when we talk about portfolio strategies, longing and buying are the same thing. Writing and shorting are the same thing. So we long a call. We bought a call and we bought a put with the same strike price. Why did we do that? Well, we're betting that the stock is going to move in either direction. So typically people will use a straddle strategy, especially around information events. Like if the firm is going to announce earnings and you think they could be really good or really bad, you don't know, but you know it's going to move the stock price around. Let's look at an option strategy called the bull spread. Now the bull spread, you'll notice, because we long a call and short a call, we're kind of betting that the stock price is going to go up. Now, we're losing a little bit relative to what would have happened had we just bought a regular call, but with the bull spread, the money that we make selling our second call is also good. So yes, we lose a little bit of the upside, but we also have a much cheaper option strategy because we're paying for a call and we're getting the premium from selling a call. Let's look at a strangle. So with the strangle, it's very similar to a straddle, but what you'll notice is that the strike price for the call and put are not identical. There's actually quite a bit of distance between these strike prices. So in this example, we bought a call with a strike price of 60 and a put with a strike price of 40. What are we betting on? We're betting that the stock price is going to move. How does this differ from the straddle? It's very similar to the straddle, but here we actually need more volatility for this to be more profitable. Well, would you expect this to cost less than the straddle? Yes, definitely. This is going to be cheaper than the straddle. Why? For the reasons that we mentioned earlier. Our last example is going to be a collar. So in this, I want you to pause and then look at these different options. What's the main intuition behind a collar? Suppose you own 100 shares of Microsoft, but you're afraid that the price is going to go down to 25 bucks a share. What can you do? Well, you already own the stock itself. So you can write a call with a strike price of 33 bucks per share, and you can buy a put with a strike price of 25. Let's make sense of that. You own the stock. When you buy the put, you're buying protection to sell the stock at 25 bucks per share, right? Because you're worried that the stock price is going to fall. Now, when you sell the call, when you write the call, short the call, what are you doing? You're promising someone the right to buy the stock from you for $33 per share. Why is that okay? That's okay for two reasons. First, when you write that call, you're actually going to get cash. Second, you're going to use that cash to buy your put. And third, you already own the stock. Because you hold the stock, you don't have to go into the market and go buy it if someone ends up using the call that you sold them. And if the stock price tanks, if it goes below 25, you've locked in 25. Okay, so the reason why we've gone through those option strategies is because I want you to be familiar with the ways that companies all the time try to lock in prices and hedge their risk. For example, airline companies quite often will use call options on crude oil. This was a strategy that was adopted by Southwest and by a few other airline companies as a way of basically hedging or reducing the risk for a major input that goes into their pricing. However, whenever you're long on a call option or whenever you're long on anything, you always worry about the potential losses from those investment strategies. These next two slides are going to build some of the foundations for how you actually price an option. So stocks and bonds can be thought of as options based on their underlying value of firm assets. Hypothetically, the assets of the firm could always be sold off, where bondholders get paid first, and then equity holders get what remains of the firm. The person who really brought this to light was Merton in 1974 with the Merton model. So we're just going to put in some very simple parameters. The main idea is for you to understand how this can be applied to a firm. Suppose the firm owns some assets that have a volatility of 20%. There are two claims on the firm. There's equity and there's debt. The debt is zero coupon, so you don't pay anything. It has a 5-year maturity. At the end of 5 years, the debt holders are going to receive the value of their debt if the firm can pay it. If the firm can't pay it, you go bankrupt, you sell off what you can, and the debt holders are repaid from that. The equity owners only get whatever's left over when the debt is paid. That sounds a lot like an option. So what does that mean? Well, the equity is nothing more than a call option on the value of the firm, and the strike price is really the face value of the debt. So in our example, we said that the debt had a face value of 1,000. So if we mature, if 5 years from now, the firm has a value of 500, we're basically bankrupt because we can't pay off the debt. And everything above that 1,000 goes to our equity holders. So we think of equity as a call option on the value of the firm. We can also think about our debt as basically a put option. Now, this one can be a little bit harder to see, but this is basically a risk-free bond minus a put option. Why do I say minus a put option? Well, here, hopefully what you observe is that anything below that $1,000, that is going to be what the debt holders get. And once you reach firm assets of 1,000, remember the debt is going to be capped. It's not super important for you to totally understand the Merton model, but I want you to at least be familiar with this idea of thinking of equity as a call option on the value of the firm. So our next lecture will cover real options, and yeah, we're going to jump into it right now.